Right now, something important is discussed. In a financial system millions trust for honest pricing is quietly breaking down. A line has been crossed in the silver market, and almost nobody is reacting with urgency it deserves. Here is the disturbing question hanging in the air. When major banks release extreme targets, who benefits first? Markets do not whisper numbers like $125 unless something underneath them is already unstable and stressed dangerously. At first glance, it looks like just another bold forecast, a headline, or an analyst's extreme opinion. Big institutions do not casually release numbers that extreme without strong internal justification or concerning data. They only do it when risk models begin to fail and historical assumptions stop working. The gap between paper markets and physical reality has grown far too large to ignore anymore. Silver's not behaving like a normal commodity anymore, and that is where this story begins. For most of modern history, silver has lived a double life, both underestimated and absolutely essential. Silver is both industrially critical and historically a monetary metal, making it uniquely dangerous under stress. That contradiction is not new. It is deeply rooted in thousands of years of economic history. For centuries, silver was money itself, not a store of value, not an alternative asset class. Empires depended on silver, and flows stopped or were debased. Economic systems collapsed violently. Rome, China, and Europe all experienced crises when silver scarcity or debasement disrupted trade and taxation. These lessons were never forgotten, even if public attention drifted away during peaceful times. The 20th century rewrote the rules, demoting silver from monetary metal to industrial commodity status. Gold remained sacred and central. Silver was intentionally sidelined and treated as a secondary resource. Governments sold reserves, central banks ignored it, and markets were told silver no longer mattered strategically. Meanwhile, industries quietly absorbed it for electronics, medicine, and military applications without much public attention. Eventually, the energy transition locked itself onto silver as an essential material for infrastructure. Solar panels, electric vehicles, data centers, and grids all require silver to function reliably at scale. Silver is not consumed like oil. It is dispersed, diluted, and often lost in countless devices permanently. That dynamic created structural scarcity even while markets continued to behave as if supply was abundant. Paper contracts expanded faster than physical availability, creating the illusion of endless silver supply globally. Futures, options, ETFs, and derivatives created synthetic abundance detached entirely from metal and vaults. The market relied on one fragile assumption. Most participants would never request physical delivery. Industrial demand accelerated quietly as renewable energy, electric vehicles, and defense systems grew rapidly worldwide. Meanwhile, mining production stagnated because silver is mostly a byproduct, not mined directly at scale. Even higher prices could not immediately increase supply, forming structural deficits over decades. More silver was consumed globally than produced, slowly draining inventories without public awareness. This is the origin of the silver tsunami that most people still cannot see clearly today. Physical markets began to show friction. Premiums rose, delivery times stretched, regional shortages emerged subtly. Most observers dismissed these signals as temporary logistics issues, not systemic stress or structural scarcity. Shanghai exchanges could not ignore the stress, as they track real flows and physical settlement carefully. Then something shifted suddenly, without public explanation or prior warning in the trading community. Margins were adjusted, trading rules tightened, signaling urgency behind closed doors and private settlements. Exchanges only clamp down when settlement risks threaten systemic failure across the market. This marks the breaking point phase, which is always confusing in real time for most traders. When too many claims chase too little metal, confidence becomes the bridge holding the system together. Once participants start questioning whether contracts represent real silver, liquidity vanishes almost instantly. Volatility spikes, correlations break, and price discovery stops functioning properly in such moments. That is when resets happen and markets begin repricing far more violently than expected. The fallout never stays confined to trading floors or futures exchanges alone. Silver underpins critical industries. When its availability tightens, costs ripple across energy, manufacturing, and technology. Projects are delayed, contracts renegotiated, and governments blame inflation or logistics rather than material stress. Shanghai's panic move suggests the stress is no longer theoretical. It is already manifesting physically. Attempts to fix these moments always fail because they treat symptoms, not underlying structural shortages. Paper supply can expand infinitely. Physical silver cannot. Recycling is slow and inefficient for large volumes. Substitutions degrade performance, increase costs, and cannot solve industrial-scale deficits quickly enough. Mining new silver takes years, so there is no emergency lever to instantly release metal. Every prior silver crisis followed this same arc: calm, denial, friction, volatility, intervention, repricing, and memory loss. The modern parallel is clear and impossible to ignore if history repeats itself again. We have seen similar patterns in housing in 2008, sovereign debt crises in Europe, and energy markets repeatedly. Early warnings were dismissed repeatedly because they contradicted comfort narratives, delaying appropriate action until too late. Silver today exhibits identical fingerprints: small market, outsized leverage, strategic industrial importance, and physical scarcity. Quiet institutional repositioning is happening before price behavior publicly confirms the stress is real. Extreme numbers entering public discussion are not predictions. They are boundary conditions of a failing system. Banks use these numbers to warn internally and position ahead of inevitable repricing events. The breaking point occurs when settlement confidence collapses and paper no longer reflects physical reality. This is when resets become unavoidable, and markets begin functioning according to real supply constraints. The ripple effects reach far beyond financial traders into critical global industries and infrastructure. Energy projects stall, manufacturing costs spike, and governments face trade-offs between stability and credibility. Historically, confidence fractures across asset classes during these moments, amplifying volatility and systemic risk. Emergency fixes fail repeatedly because they cannot create physical silver or solve structural scarcity. These measures temporarily slow panic, but do not prevent eventual repricing or industrial disruption. Paper markets expand endlessly, but metal shortages eventually force true price discovery violently. Eastern markets quietly accumulate physical silver, while Western markets rely on paper hedges, creating asymmetry. This imbalance intensifies over time, draining metal eastward and leaving leveraged claims exposed in the West. Shanghai's recent moves indicate this structural threshold may now be approaching rapidly. When domestic stability is prioritized, silver is treated as a strategic metal and controlled carefully. Free market pricing cannot survive indefinitely when strategic reserves dominate allocation decisions. Every major financial rupture shares the same pattern: .com/denial, technical interventions followed by violent repricing. Silver today is following this historical pattern almost perfectly, signaling systemic risk in the shadows. Small markets, outsized leverage, rising strategic importance, and quiet institutional warnings all point to imminent stress. First takeaway: silver is no longer a simple trade or hedge. It is a systemic pressure point. Second takeaway: paper prices do not reflect physical reality. When confidence fails, price discovery relocates rapidly. Third takeaway: extreme bank targets are warnings of what happens when suppression mechanisms fail. The warning is about trust, not timing. Resets occur quietly, often between headlines or over weekends. By the time certainty appears, positioning is already finished, and the market has repriced dramatically. The open-ended question remains: if major banks discuss scenarios that seem impossible, what are they seeing that we cannot? That question matters because when the tsunami becomes visible, it is already too late to outrun it. If you want to understand hidden stress points and signals before the headlines, subscribe now for critical updates.